Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, $350 billion.
Yeah, that is a staggering number.
I mean, that is just a mountain of cash. Right now, in April 2026, Warren Buffett and his company, Berkshire Hathaway, are just sitting on this massive pile of cash and short-term U.S. Treasury
Oh,
bills.
absolutely. It's historic.
Right. And put that into perspective for you listening, that single cash pile is actually larger than the total value of some of the biggest corporations in the world.
Yeah, it really is crazy to think about.
So it forces us to ask a really important question here. Why is an investor whose entire reputation is built on, buying and holding great American companies suddenly hoarding all this money?
Right, and the sheer scale of it tells us that this isn't just a passive thing.
Exactly. So in this deep dive, we are looking at recent economic data to understand exactly what that $350 billion is waiting for. We're going to explore the US dollar, look at some hidden cracks in the financial system, and really figure out what this means for you, the everyday investor.
Yeah, because it's a highly defensive, incredibly deliberate, tactical move. It's based on some very specific macroeconomic indicators.
Right. So to understand why he's buying mountains of U.S. Treasury bills, I guess we need to start with the currency behind them. Like, is the U.S. dollar still the absolute safest bet in the world?
Well, looking at the data, the dollar definitely remains the dominant force. But the pillars holding up that dominance are seeing some real friction lately.
Friction how? Like, what do the numbers actually say?
So according to recent analysis of IMF COFR data, this is from the fourth quarter of 2025, the U.S. dollar still holds a massive 56.77% share of global foreign exchange reserves.
Okay, so almost 57%. That's still a huge majority.
Oh, massive. And based on official records tracked by Reuters in early April 2026, the dollar actually rebounded by 1.6% in the first quarter.
Wow. Okay, so it's still king. And I mean, that dominance doesn't just happen by accident, right? It's protected by things that other currencies just don't have.
Yeah, exactly. You have the absolute scale of the U.S. economy, for one.
Right. And the U.S. debt market.
Yeah.
The sheer depth of it. If a foreign country needs to park, say, $1 trillion, the U.S. Treasury market is really one of the only places big enough to absorb that without messing up the prices.
Spot on. Plus, there's the fact that the U.S. is a net energy exporter now. We produce our own oil and gas.
Which is a huge deal, right? Especially with geopolitical shocks.
It's a massive structural advantage. I mean, look at the conflicts in the Middle East right now. If you're a country in Europe or Asia that relies on imported energy, you're taking an immediate economic hit when supplies are threatened.
Yeah, because your energy prices just skyrocket.
Exactly. But the U.S. economy is fundamentally insulated from those specific supply shocks. That really reinforces the dollar's strength during global crises.
Okay, but you mentioned friction earlier, so the data is starting to show some cracks in that safety.
Yeah, it is. The dollar is king, but the loyalty of the global financial system is, well, it's shifting a bit. We're seeing this distinct restlessness among central banks globally.
Restlessness, like what are they doing?
Well, a recent survey shows that 40% of them are actively considering increasing their gold reserves.
Wait, 40%? That's almost half.
Yeah. And it's not just some random preference for gold. It's a direct response to the pressure created by a really strong dollar.
Okay, let's break that down for the listener. Why does a strong dollar put pressure on other countries?
So take Asian markets like India and the Philippines.
Yeah.
They are dealing with a brutal combination of high global oil prices and a dominant U.S. dollar.
Right, because global oil is priced in dollars.
Exactly. So a strong U.S. dollar means a barrel of oil costs way more in their local currencies, like rupees or pesos.
It's like they're basically importing inflation directly into their own economies.
Yes, that is exactly what's happening. And to stop their local currencies from just completely collapsing under that weight, their central banks have to intervene.
Right, they have to defend their money.
They do. They intervene by selling off their foreign reserves to buy back their own currency and prop up the value. And since a huge chunk of those foreign reserves are held in U.S. Treasuries.
Oh, I see where this is going.
Right. Defending their currency means they physically have to sell off U.S. debt. It creates this loop where a strong dollar actually forces foreign governments to dump U.S. government bonds.
That is a tough spot to be in. And I guess we also have to factor in domestic politics, right? I mean, it's April 2026. President Trump is in the White House.
Yeah, and regardless of anyone's political views, the financial markets simply have to price in the reality of the current administration.
Right. The markets just care about data and stability.
Exactly. And according to an April and 3 survey of market analysts, there are growing concerns about U.S. policy uncertainty and whether the Federal Reserve can maintain its long-term independence.
Okay, so that absolute safety label the dollar has always had, that's kind of getting chipped away.
It is. That premium, the idea that the dollar requires zero second guessing,
Right.
is slowly shrinking.
It's like, think of the US dollar like the most historic, famous restaurant in your city.
Okay, I like this.
Right, so it still commands basically a 57% market share of all the diners in town. It is packed every single night.
Yeah, it's the place to be.
But lately, the service is a little slower, the prices have gone up, and management keeps tweaking the menu. So now some of those loyal regulars, the ones who have eaten there for decades, are quietly standing outside looking at the menu of the new spot across the street.
That new spot being gold or maybe another currency.
Exactly. Like, the historic restaurant isn't going bankrupt tomorrow. It's not shutting its doors. But it doesn't get a free pass just based on nostalgia anymore. It has to actually work to justify its premium prices.
That captures the dynamic perfectly. The data doesn't point to an overnight dollar collapse or hyperinflation. It's just a gradual diversification.
Right. So instead of all the panic money going straight to the dollar, it's getting split up.
Yes, a large portion still goes to the dollar, but more and more is flowing into gold and alternative assets. It's tension within the system, not the destruction of it.
Okay, that makes sense. But if the dollar is just facing a slow shift, that doesn't really explain Warren Buffett hoarding $350 billion, does it?
No, it doesn't.
Like, for that level of defense, we need to look closer to home, look at the actual plumbing of our financial system. So based on the data, are we looking at another 2008-style banking crisis?
The short answer there is no. At least not with the traditional banks.
Oh, really?
Yeah, according to the FOMC minutes from March 17th and 18th, those are the detailed notes from the Federal Reserve. The traditional banking foundation is very stable.
Okay, well, that's good news for the everyday listener.
It is. The domestic funding markets and the repo environments are functioning really smoothly right now.
And just for anyone listening who doesn't know, the repo market is basically the overnight lending system where banks trade safe collateral for cash. It's how they meet their daily requirements.
Right. And if that plumbing is clear, the main banks are highly liquid. In fact, Federal Reserve Chair Jerome Powell just said in early April that the localized issues popping up aren't spreading to the broader banking system.
Okay, but you said localized issues, so where is the actual problem?
Well, that's the thing. The stress has migrated away from heavily regulated banks and moved into the private credit markets.
Private credit. Okay, let's define that. For you listening, private credit is basically a huge system of non-bank lending. So think private equity funds or hedge funds lending massive amounts of money directly to companies. And it happens totally outside the strict rules of traditional banking.
Exactly. It's an unregulated shadow system. And that is where the pressure is building fast. The Federal Reserve minutes specifically pointed to rapid price drops in software-related loans.
Software loans. Why software?
Because of the AI shock. With artificial intelligence advancing so fast in 2026, a software company that looked like a sure thing 2 years ago suddenly looks completely obsolete.
Oh, wow. Yeah, that makes total sense.
Right. The technology moves so fast that the underlying value of the company gets wiped out, which means the collateral backing those massive private credit loans just vanishes overnight.
And if the collateral vanishes, the risk for the whole fund goes through the roof.
Exactly. And the minutes also noted that a lot of investors are seeing this and asking for their money back. They're submitting redemption requests.
But those funds don't just hold cash, do they?
No, they hold complex, illiquid loans. So when a bunch of investors want cash at the same time, the fund is forced into a fire sale. They have to sell assets at a huge discount just to pay people out.
Okay, so to visualize this for the listener, think of the entire financial system like a big house you own.
Okay.
Right now, the foundation and the main living room, which are the big traditional banks, those are totally solid. The concrete is holding up great.
Good, yeah.
But out in the wooden shed in the backyard, the private credit market there is a very active, rapidly spreading termite problem.
I love that analogy. It's so accurate.
Right, and the real danger isn't necessarily that the shed falls down. The danger is that the shed is connected to the main house.
Yes, because traditional banks provide massive lines of credit to those exact private credit funds. Regulators are basically sweeping the house right now to see if the termites have chewed their way from the shed into the main walls.
Which explains why regulators are suddenly getting so aggressive. Recent analysis from Reuters on April 10 showed the Fed is starting to interrogate big banks about their exposure to private credit.
And it's not just the U.S. On March 17th, the Bank of England announced they were tweaking their bank liquidity rules. They're heavily influenced by what happened with Silicon Valley Bank and Credit Suisse.
Right, those banks went down incredibly fast.
Exactly. So globally, regulators are moving away from what they call peacetime capital ratios.
Peacetime meaning when markets are perfectly normal and you can easily sell an asset if you need to.
Right. But in a crisis, markets don't work like that. So the new obsession is crisis time cashability. Regulators want to know exactly how fast a bank can turn its assets into cold, hard cash when absolutely nobody wants to buy.
Because a panic doesn't move slowly like inflation, it moves at the speed of trust.
Beautifully said. Once confidence breaks, those credit lines between the big banks and the backyard shed get maxed out in minutes. The risk is hiding in the shadows now.
Man, okay, so bringing this all back to Warren Buffett, he's sitting on $350 billion. When you combine the slow shift away from the dollar and this termite problem in private credit, his cash pile doesn't look like fear anymore. It looks like a highly calculated strategy.
It looks predatory, honestly. The numbers are just wild. Berkshire Hathaway's 2025 annual report showed $47.7 billion in straight cash and a massive $321.4 billion in short-term U.S. Treasury bills.
And he's still buying, right?
Oh, yeah. In a recent interview, he confirmed buying $17 billion in T-bills in a single week.
$17 billion in a week. That is wild. But let's look at what he's actually buying. He's not buying 30-year bonds. He's buying short-term T-bills, which mature in under a year.
And that is the key to the whole strategy. According to an April 10 market analysis, people expect the Federal Reserve to keep interest rates steady through late 2026.
Okay, so because rates are staying high, those short-term T-bills are paying out a really high yield.
Exactly. You are getting paid heavily by the government just to wait. The opportunity cost of holding cash right now is basically zero.
You know, I think there's a big misconception here for the everyday listener.
What's that?
Well, when people hear someone has $350 billion in cash, they assume panic. They think, oh, Buffett is terrified of a crash, so he's hiding his money under a giant mattress.
Right.
But holding short-term T-bills right now isn't a mattress. It's a loaded spring.
A loaded spring, yes. That is what finance folks call option value.
Explain that a bit more. Option value.
Well, hiding money under a mattress is just trying not to lose it. But option value is intentionally hoarding potential energy. By keeping all that money perfectly liquid, you have the freedom to strike with massive force the second the market breaks.
Because if those private credit termites finally cause a collapse, those heavily leveraged funds are going to get hit with massive redemption requests.
Exactly. And they will be forced to liquidate. They'll have to sell off shares in amazing, historically profitable companies at absolute bargain basement prices just to get emergency cash.
And who is going to be sitting there with $350 billion in pure liquidity, ready to buy those great companies at a massive discount?
Warren Buffett. Based on an April 1st Reuters analysis, during the market stress in March, gold and long-term bonds completely failed to protect portfolios. The only thing that worked was cash.
Because it gives you the option to act. He isn't panicking. He is literally buying the option to strike when everyone else is forced to sell.
He's positioning himself to be the sole provider of liquidity when the market is gasping for it. It's brilliant.
It really is. So just synthesizing all this for our listener today. The economy in 2026 is shifting. The U.S. dollar is still the main pillar, but it's sharing the spotlight a bit more as other countries diversify.
Right.
And meanwhile, the real risks have moved out of the traditional banks and into the private credit markets, where things like AI software loans are rotting the foundation.
Exactly. And amidst all that chaos, you have the most disciplined investor in the world refusing to play the game, building a war chest, and getting paid high interest just to wait for his moment.
And for you listening, you don't need $350 billion to use this strategy. The big lesson here for the everyday investor is that blindly chasing high yields right now is dangerous.
Very dangerous.
You need to prioritize liquidity, you need to understand exactly what is in your portfolio, and make sure your own financial house is solid before those termites cause a real correction.
That is the ultimate takeaway. And I want to leave the listener with a final provocative thought.
Let's hear it.
If the most successful investor in modern history views cash not as a waiting room, but as a strategic weapon, how does that change the way you view your own savings account?
Oh, that's a great question.
Right. When you look at your emergency fund, are you holding that cash just out of fear? Or have you categorized it as a loaded spring? An option that gives you the power to strike when the rest of the world is panicking.
Wow. A truly vital question to carry with you as we navigate these markets. Don't forget to subscribe and hit that like button.